Hello everyone, this is Jim Martens. When using the wave principle, we're looking for reoccurring price patterns at different degrees of trend. Today I want to walk you through a recent example of how we spotted a corrective movement in dollar Swiss. So you can see the 4-hour chart, and just to get us started, we had decided, based on the wave principle, that a corrective price pattern had ended at the low in March. The subsequent rise, as you can see, was very consistent. When setbacks occurred, they were brief and shallow. The path of least resistance was easily recognizable, and it was to the upside. But the setback that occurred from above 94.50 followed a different path. It's not as steady. In fact, there's a sizable pause in the middle of that decline. And that pause followed what we refer to as a corrective path. That is, it unfolded in 3 waves. And we labeled it as shown here, A, B, C. Now wave B is interesting because it followed the path of an expanded flat, where there was a new low registered within the correction before the market rallied back, and as you can see, wave C of B exceeded the end of wave A. So we spotted that, anticipated another decline sequence. And as you can see, the market followed those expectations. And even at this 4-hour chart level, you can see that wave C unfolded in 5 waves, signaling that the path of least resistance was to the downside in this case. And when we looked at that decline at a shorter time frame, in this case a 1-hour chart, we could count the decline in wave C in 5 waves. 1, 2, an extended third wave, a sideways consolidation in wave 4, which we refer to as a triangle, followed by a thrust from a triangle down to 91.95. Now that triangle, like a corrective movement, which is in 3 waves, sends a message to us. It tells us that the next movement will be the final movement in the larger sequence, in this case in wave C. So we knew, based on pattern, 3 waves down from the high, A, B, C, and then being able to count 5 waves down in wave C, with wave 5 a terminal thrust from a triangle, that dollar Swiss should put in a low, which it did at 91.95, and you can see afterwards how the market has been advancing. If we look back to the 4-hour chart, you can see a relationship we often look for within corrective movements. Wave C often travels a similar distance as wave A, and in this case it would have traveled the exact same distance as at 92.15. The exact low was just a bit lower at 91.95, but it was quickly reversed. So you can see in this example how we were able to follow a corrective movement to its conclusion, identify with a high degree of confidence that the decline was coming to an end and that a reversal was due as the market had satisfied expectations both structurally and then the relationship between wave C and A. We see these kinds of patterns regularly in markets, and when we're using the wave principle, this is one of the most simple corrective patterns to look for. It's called a zigzag. And when you see it, it can send a powerful message of what lies ahead.